Joining us is Jill Carey Hall, head of small and mid-cap strategy at Bank of America Global Research. You weren't rolling your eyes. You were fine with that quickly, right? Jill, we had someone, and it opened my eyes to the possibility. We had someone that say we will test the lows, and the chief guy at Piper, and the 3,200 is not unthinkable given what kind of slowdown we could eventually see from the Fed and especially earnings revisions. Mm-hmm. That's not in your forecast. 4,000 is not very far below where we are right now.
Right, 4,000 is our year-end target, and I mean, as a downside risk, we've certainly thought as a bear case the market could go into the low 3,000s, but our base case is we end the year at 4,000. I think there could be more downside risk near term. So heading into the year, sentiment on had been very poor in the first half, so we obviously saw the big January rebound, but there's risk we could see volatility from here. We are expecting 2 more Fed hikes. We are expecting a mild recession to start in the third quarter. So it's possible that we do go down before we go up, and I think right now the focus is going to be on the economy and the backdrop, and we do think earnings still need to fall further.
So is the S&P at this point what doesn't kill it makes it stronger, or is it whistling past the graveyard? Why the disconnect between? There's nobody who hasn't heard what you just said. I said that to this gentleman the other day. What are you saying that isn't known right now, or at least assumed? This is already sort of what's assumed for what the future looks like. Why isn't the S&P cooperating by going down?
Yeah, I mean, I think there's still, a lot of optimism, and we've seen a lot of optimism on earnings calls, but actual guidance has been weak. Corporates have been resilient. Margins only contracted slightly this quarter, but I think there's a lot of cross currents going on right now. The market's still not fully pricing in a recession in our view, so I think there's more opportunity in pockets of the market, areas like small caps that have been more adequately pricing in the risks and where we could see more upside.
So it's just going to be a grinding. It's only, is it February? I think it's February. Was yesterday Valentine's Day? I think I got that right. So it's February. The rest of the year.
2 days ago. It's February 16th. So.
Oh, it is, right. Okay, so we're at 41.47. So the rest of the year, 10 more months, we end up at 4,000. It's going to be a grinding, tough slog. What do you think the range? You think it could be 3,800 to 4,300, something like that? But pick your stocks.
Yeah, I mean, I think, like I said, there's risk we could go down before we bottom, and usually the market bottoms about 6 months before the recession ends. So, could argue for at some point later this year we see more of a firm bottom and upside. But I think, there's so many cross currents going on within the market this year that we do think it's going to be a year that's more about, picking your spots, active management over passive. We think the rest of the market outside of the top 50 mega caps looks more attractive than the mega caps. We like small caps, as I mentioned. I think, tech looks risky. We still think even amid all the layoffs, their, labor relative to their real sales growth is still relatively bloated.
It's had a great bounce, but you figure it's petering out, tech?
Yeah, I mean, we think there's, we have peak globalization. There's all these things that have benefited tech for many years, low interest rates that I think on a secular basis are reversing, and tech's still a cyclical sector if we go into a recession.